Barry, I want reasons investors should get behind New Century Resources.
One of the main reasons for it is the fact that 36% of the stock is owned by board management and the actual people executing the works themselves. So it's quite a rare thing in the mining industry where you have such a large alignment of interest between the people out there carrying out the job and the people who are investing in the stock themselves. So there's no one in this company that has the agency effect where they're just here to collect a paycheck. No one's on massive salaries or anything like that. So our interests are uniquely aligned with that of the investors because essentially we get a payday when the investors get a payday because we're all one and the same effectively. The other part of it as well is it's a project that will produce significant cash flows, and that cash flow is we're planning on using that to pay dividends to shareholders. So that's how we will actually get our return on investment, if you will. Mm-hmm. So you have a very aligned management group. You have a large amount of cash flow that's going to be used to pay dividends back to shareholders themselves. Mm-hmm. It's a mining operation that's in the lowest cost quartile. So you're going to be able to ride through various different cycles in zinc price and all the rest of it. It's going to be profitable through all of those fluctuations in zinc price. And it's something that we're actually setting up the operation with the view to be able to ride any of those fluctuations as well anyway. So I suppose those are the three key reasons that you would be wanting to invest in our stock.
Any M&A on the horizon?
Right now, at the moment, we're hugely focused on just executing and doing what we said we were going to be doing, and returning that money to shareholders. Longer term, there's no reason why this business model doesn't make a lot of sense for a lot of other operations out there, because there are a lot of major mining companies out there that aren't in the business of rehabilitating mine sites and looking at operations through a unique lens to unlock any residual value or potential additional value on a mine site. So the view to taking advantage of sunk capital and the infrastructure assets on a mine site to reprocess and or mine additional mineral resources on a mine site is something we will look to. Okay. But for right now, we really are focused on doing what we said we were going to do on the mine site and returning as much of that value to shareholders as possible.
Great. Thanks for that. I just want to talk to you about the zinc market.
Yes.
I mean, if you're investing in zinc, you've got to believe in where the zinc market is going. Mm-hmm. Same is true of gold, same is true of silver. So can you just talk us through, the last zinc cycle and where you think it's going this year and next?
Well, I suppose where we are now is we're at historical last 10-year high zinc prices. But that's for a number of very specific reasons. You've had quite a large amount of the bigger mine sites in the way of supply shut off in the last few years, of which actually Century was one of them, and then there was Lachine and a few other mine sites that have turned off over the last couple of years. And demand has been on average about growth of about 2%. So there you're looking at about 290,000 tonnes worth of zinc metal units in increase in demand per annum. So that's a very significant mine that needs to come on to replace that, or group of mines to actually replace that increasing demand. And that's just not really happening at the moment. So you're looking at the LME stockpiles in refined zinc that's been dropping off as well. So for all those reasons, it looks that the next few years there will actually be a very good zinc price environment.
Right. Okay. Yeah. And where you're obviously cash flowing, which is great. Yep. You're selling to where? You mentioned China.
So we've sold into China already.
Is that where most of the demand for zinc is going to be, or is it global?
I think it's a global demand. We have offtakes with quite a few of the major trading houses, and they'll sell that internationally to wherever the demand is. And I suppose it's good to note and keep in mind that Century, when it was operating on in situ resources, used to produce 1 million tonnes per annum of concentrate, And with that amount of concentrate, it was sold to all smelters all over the world. And so smelters all over the world are very, very familiar with the Century Zinc concentrate, of which ours is pretty much the same makeup as what they made previously. And no smelter takes only one type of concentrate or one specific concentrate. They take a blend of different concentrates, and that makes up the mix that then goes on into the smelters. So pretty much most zinc smelters are familiar with and understand the Century Zinc concentrate and are looking to get more of it.
Okay, so interesting. And obviously you're looking to ramp up your production.
Yes.
You've got storage facilities. Have you got enough?
Yes.
You have.
Yeah. So
and will you be trading on spot, or are you getting contract? How does that work?
So currently we've got offtake agreements for 80% of our production.
So being contract?
Yes, but it's an offtake contract which is based on spot prices.
Okay.
So it's just basically that we have buyers for the concentrate that we're producing, and we're in the process of discussing potentially getting an offtake contract for the remaining 20% of our production.
Interesting.
But again, that follows spot price, so you do have that exposure to where the price goes, up or down. To talk to your other points about storage capacity, we do have a storage shed which has the capacity for 80,000 tonnes of zinc concentrate. So it's quite a substantial shed, 250 metres long. And we do have the processing facilities there to press, dry and store what they used to produce, which was that 1 million tonnes per annum of concentrate. Right. So we have more than sufficient capacity at the port facility to handle as much concentrate as we'll produce. I mean, our maximum run rate would be probably 500,000 tonnes of concentrate per annum. So
right. Now, talking of the port,
yes,
we know there's been some disruption due to rain, a lot of water around to some of the tracks out there. Has that affected you at all?
Yeah, so talking about the massive rain event that happened in the far north Queensland and specifically around the Townsville region, we were very, very fortunate in the fact that how our concentrate actually gets through to the port is through a 304 kilometre slurry pipeline, which is actually buried. It still is, to this day, the largest single pump slurry pipeline in the world. So a really impressive bit of infrastructure. And that's been operating and still is operating perfectly fine, being that it's buried and underneath where all the water came through. So a lot of the other operations in the region actually get their concentrate to market via the train line that goes from Mount Isa down to Townsville. And there's been significant disruption to that, where a lot of that has actually been washed away. So we were very, very fortunate in the fact that we had slight interruptions to the hydro mining for about 4 days. But otherwise, it has barely affected us in what we're doing there, and we still have our whole supply chain and everything operating as it should be.
Well, that's very fortunate.
Yes.
Very fortunate. So, looking around some of the chat rooms and forums, I mean, people are kind of interested in a bit more news flow around recovery rates and how you see that looking. You know, what are you running at the moment in terms of your recovery rates? So
recovery rates at the moment are high 40s, low 50s.
Right. Okay.
Yeah.
And you're looking to get that to where?
So 61% is what our targeted recoveries are, and we believe we'll be there by midway through this calendar year.
Right. Very confident about that.
Yes. Yeah.
Okay.
Yeah. So I mean, it's key to understand that. Essentially, we were bringing 80-odd people in the processing plant together from various different operations around Australia. You're bringing them all together and getting those teams up to speed with how you want to operate our processing plant. The last of those people actually came and joined us sort of in November. So we haven't had the teams together for very long, and getting them up to speed with how we operate our plant and the expectations around how we want things done takes a bit of time, and then you're training and ticketing and getting all that side of things done, which we've done up until this point now, and we're very confident in the teams we've got and their knowledge of what needs to be getting done. Second thing to take note on as well is, whilst it's a very well built plant that was built by Bechtel back in the late 90s, it was operated for 16 years and then it was put into care and maintenance for 2 years. Any plant that you then turn on, you can refurbish it as well as you want. But things will start to fail as you run the processing plant. So we're really going through a period now of having things fail that need to be fixed, and finalising and fixing things and getting it all sorted out so you get that stability through the plant. And realistically, month on month, it's been about a 5% increase in our recoveries. And that's happening pretty solidly through when we started up till now. And we do have...
That will slow, presumably, as you get nearer the 60% mark.
Yes.
In terms of efficiencies, right?
Yeah, exactly. So, I mean, the last 5% that you're going to be getting is always going to be the hardest, as with any of these sorts of things.
But getting close to that quite quickly, and then
yes.
you'll assumably optimise it over
yes.
time. Okay.
Yes. Yeah.
Fantastic.
So, and that's what the test work proved, that we could get to 61% recoveries. Obviously, we're optimistic that with work and enough trials and everything else, we'll try and achieve better than that.
Yeah,
but I mean,
yeah.
even if we just achieve the 61%, we'll be very, very happy.
As shown by the IRRs that you're forecasting of 270%.
Exactly.
Right.
Exactly.
And again, talking of value
yes.
for shareholders, we're looking at page 5 of your most recent presentation, the February presentation,
yes.
looking at the EV and the NPV numbers, you're well below your peers. You're below average.
Yes.
Now, what does that tell us?
I think it's not really surprising, considering the fact that we've come through two things. I think is not a very well-known stock, quite a young stock, really, considering our evolution as a company, and going back to we only started out at the beginning of the year with a feasibility study, and then producer by the end of the year. That sort of is a very shocking time frame in how fast that's happened. But also, we've just come through a commissioning phase, so refurbishment, commissioning, and then ramp up. And traditionally, if there's ever going to be any issues in a mining company, it normally happens in that time period. So you have quite a lot of people that sit on the sidelines expecting any issues to happen in that time frame and everything else like that. And there's a lot of people that are almost waiting to see the performance and see that we're going to be in a position where we're delivering on what we said we were going to do.
Mm-hmm.
And key to note on that is we're not going to have to go back to the market to raise any equity, any more funding.
So you're cash flowing. You don't need. I know you've got a debt facility in place.
Yeah.
You've got drawn down a little bit of that.
Yes.
But presumably, as you move the production up, you're going to not necessarily, you'll keep it, I guess, but you won't necessarily use it. Is that?
Yes. So that one is we did have a debt facility with NAB. National Australia Bank,
mm-hmm.
So one of the big 4 banks in Australia,
mm-hmm.
but that was a $40 million facility,
mm-hmm.
and it was fairly covenant heavy,
right.
and we weren't able to draw all of it when we needed to. And the whole point for us with the debt facility is the capacity to smooth out our cash flows, because in this sort of space, you're producing and selling a 10,000 tonne parcel of concentrate. It's lumpy cash flows.
Absolutely.
And a large
Very
portion of
peaky.
what you need is making sure that you've got the capital to get you through all of that side of things. So going and getting the $100 million debt facility, of which we've only drawn 20 million of at the moment, was giving us that capacity where we don't have any issues with our cash flow going through. And it also gives us the capital, should we require it, through the ramp up.
Was that relatively cheap debt? I mean, would you look to get rid of it by the end of this year? What was the?
Well, it's drawn in 2 tranches. So right. The first 60 is at about 8% debt. So
right.
it's not too expensive. And
mm-hmm.
then the second 40, if we draw it, is at more expensive debt. At this stage, when we're
so you're at 8.
Yeah, we're at 8. And with the cash flow that we're going to be producing, we'll pay that down in the time that we should. Yeah.
Okay, great. And then so final question to you is around share price.
Yes.
It's recently spiked.
Yes.
A bit.
Come back.
Why do you think that is?
I think to the point that you were saying, or I think people are starting to understand that we're not going to have to go back to raise equity. We've got the funding that we need to. We're going to be having our first positive cash flow quarter, this one coming up, and then things will only be improving and getting better from there. People are understanding that from a risk perspective, majority of your risks aren't there that were perceived previously. And as the market actually starts to understand all that and understand that it is very real and we are achieving what we said we were going to achieve, people are starting to become more aware of the stock and starting to buy in to try and be a part of getting the value that's still out there between what the share price was and what it should be.